Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me on the desk this afternoon, we have Phil Mackintosh, chief economist at Nasdaq, as well as Chris Dearborn and Max Cabasso, managing directors on Nasdaq's Market Intelligence Desk. We'll also bring in our technical analyst, Brian Joyce, also on the Market Intelligence Desk. It is great to have everyone back with us. Happy New Year. And before we get into our 2024 outlook, let's go around the horn here for a bit, talk about first week trade. We're seeing that rotation trade, but Max, to your point off camera, the first 3 days of the market, 2 days of the market doesn't necessarily mean that's the way it's going to go this year.
Yeah, absolutely. I mean, look, we closed at essentially the highs last year, opposite of previous year where we basically ended the year at the lows. Again, first 2 days a bit weaker, seeing a bit of a rotation, but I don't want to get too far ahead of ourselves here. I don't think there's a ton that's changed over the past week. I guess more people are kind of getting back into their seats and kind of paying more attention to the market. But we had the Fed minutes come out today. But again, there's really nothing cataclysmic that's kind of changed anything. There's no new data points that have really pointed at a real change of what we've seen. We had a bit of a Santa Claus rally, giving some of that back today. But again, I don't want to kind of lump out 2024 is going to be, a new bear market. The recession's coming now because of the first 2 days of trading.
Right. And Phil, this is a recession that hasn't materialized that we've been talking about for what, the past 18 months here?
Yeah, still hasn't materialized. And it's looking more and more like we're going to have a soft landing. I think when we're looking at the Fed's obviously going to be cutting rates. The market says 1.5% by this year, 2% at the end of next year. I have a feeling it might even end up being more than that because that would actually be a historically slow rate of rate cuts. And so that's really good for companies that have debt refinancing coming up. It's going to be better for stocks. It's going to be a tailwind for stock valuations. It's going to be good for people trying to work out if they can buy into a new house. So it's probably going to help spur the economy. The interesting question is, with the rally that we had at the end of last year, has the market kind of got ahead of itself and already priced earnings gains, lower rates into the market? Well,
Chris, we'll find out in a couple of weeks when we kick it to high gear, with earnings. But should we get that boost in the economy? And you and I have discussed this a number of times, considering you've covered consumer so closely. It's been hard to bet against the consumer.
Consumer's been the strength and the backbone of this market-driven rally for a long, long time. And the main reason why we haven't had that recession, quote unquote, what you're really seeing here, especially the last couple of weeks, is really in the markets, the Magnificent Seven kind of really pushing forward, kind of an overbought condition really through December coming into the beginning of this month, and people just taking some profits right off the gate. You've had a couple of analyst comments and some of the big names as well that kind of spurred some fear there. But at the end of the day, what you're really looking for is that Christmas gift that Powell gave us on the Fed pivot, and now you see the markets reacting, really not reacting much to the full minutes that came out. You look at the Fed fund futures, prior to this, you were looking at 85% chance of a Fed cut in March, back in December. It toned down to about 75%, and then just looking at it right after the minutes came out, ticked down to about 73% or so. So it's still pretty dominant that we're going to see that first quarter basis point cut in March. But the question is, are we going to get 150 basis point cuts, what the market was predicting 2 weeks ago? Or we're going to get the 75 basis point cuts, which is what the Fed was saying in the minutes today.
But is this typical of January trade when you're coming off of a year that no one expected the S&P being up nearly 25%? Who's going to sell into the end of the year, right? And if you think that valuations are too high, let everyone sell in the beginning of the year as expected. Then you have your opportunity to get in at better levels.
You had inflows coming in after the October sales for mutual funds. That's the tax loss selling on the institutional side. That ends October 31st for the most part. And then you have retail and smaller funds that'll sell into it. But if you're not taking losses, why are you going to take gains? Ride it till next year and see what this year brings. I mean, you've got so much going on between the geopolitical situation, an upcoming election. Lord knows what's going to happen with that and what the markets are going to reaction to. Take some profits now and let's see what happens.
All right. Speaking of that, let's get a technical read on this, bringing in Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, our resident technician here. Brian, let's take a look at the S&P 500. We'll also take a look at the VIX, our volatility reading. We'll also touch on Bitcoin as well. First, Brian, let's get some fresh technical levels to watch in the S&P following the big move that it had in 2023.
Certainly, Jill. Thanks for having me. So as Max was highlighting earlier, we've seen, a modest pullback here in the first 3 or 4 sessions of the year. We haven't even broken down below the 20-day moving average. So even any security that's in a strong uptrend, will always experience some relatively minor pullbacks. And, that 20-day moving average is a common level to see, pullbacks find support as long as that strong uptrend is maintained. So we're still, well above that 50-day moving average, which is down at 45.21. So at the moment, I would focus on the 200-day, which is 4,700, about 20 points below from here. And if we are going to see a more more profound correction, I would think maybe then the next logical level would be looking down at 46.07, which was the highs made back in the summer of 23 before that 3-month correction started here. But, as noted here on the weekly period chart, we could see that, last week's high, which was multi-year highs, came within 1% of the highs made back in January of 22. So this is a logical level to expect, a period of consolidation to take place. We, as you noted, had the big uptrend. Daily RSI reached a peak of 82 in mid-December. And then when the index itself pushed modestly higher, we had a bearish divergence where the daily RSI made a lower high. So again, at the moment, just very, it seems like logical pullback here. Nothing concerning at all.
Right, and if we take a look at the VIX, I would imagine that you're seeing the inverse of that to kick off the year.
Yeah, certainly. The VIX is trading near multi-year lows. We're looking here at a weekly period setup here, and we're just coming off the 1180 level, which we haven't seen since late 2019, early 2020. So as the markets are making new highs, typically we're seeing less volatility, and that certainly has been the case here. We have seen a little bit of an uptick in the last week or so. Here we are. So we bottomed back in December 15th. At around 1180.85, and we got as high as 14 today. So nothing explosive here to the upside, nothing yet too concerning. But these tails here have been kind of peaking around 14.5 to 15. So I would maybe look to see there if there's a move above there on a closing basis, then maybe there's a concern that we'll have a deeper pullback in the equity market.
And finally, let's take a look at Bitcoin here, having quite the move going into the end of the year, seeing a little bit of a reversal here. January 3rd, 2023 marks the 15th anniversary of Bitcoin coming online. Let's take a look at some fresh levels.
Yeah, so I'm highlighting here the last week of October ending the 10/29. It was the week before on the 22nd where Bitcoin really kind of had liftoff, gained 10% the prior week on the 22nd, liftoff from the 200-day moving average, and then on the 29th, it gained another 15%, so, or let's say 16%, and then has been in an uptrend ever since. So more recently, in the last few weeks, we're in this, bull flag kind of consolidation here. It's right around the 45,000 level. We could see that this level was also, marked a top going back into early first half 2022, which is where the 200-day moving average, had been. So to me, it looks like constructive consolidation over a 3-4 week time period, right along a prior period of resistance. And so, nothing yet concerning to me. I know we're seeing a little bit of a pullback in the last day or so, but if you look at it on the weekly period, you can really see that we're just kind of going sideways for 4 or 5 weeks now.
All right, Brian, appreciate the technical insight as always. Thanks for joining us. Max, let's talk about Bitcoin for a moment here. It seems like 15 years, it went by really quick, but when you think about it in terms of maturation of the asset class, that's certainly very quick considering stocks have been around for hundreds of years.
Yeah, it's still very early days. It seems like it's been a lot quicker because of the advent of the internet and smartphones, and everybody's kind of in a 24/7 news cycle where you're just hearing about it. Everybody has an opinion. Obviously, it's been a volatile asset, so it draws a lot of headlines. But like you said, 15 years ago today was the Genesis block when Satoshi came out, with Bitcoin for the first one. So again, it's still relatively new. Obviously, we have potential ETF approvals for spot Bitcoin ETFs potentially coming this quarter. I know today there were some reports, that it was going to be rejected. That's what kind of took the market down a bit. But again, supposedly there's reports that there's meetings today with the exchanges and the SEC about, having them come on. The new FASB rules coming end of the year, where corporates can now have it on their balance sheet. It's no longer an intangible asset, so it's constructive. Obviously there's another halving coming up in April. So on a fundamental level, I guess you could say, if we can call it that, there's a lot, of a bull case there. Again, today a bit of a pullback on those reports, but I expect this to get a lot more, activity as we go throughout the year into the second quarter and to the midway point of the year. I think it's going to start to pick up again.
Yeah, well, it's so interesting because there's so much bullish sentiment around the ETF approval if and when it happens. It almost makes you wonder, is that somewhat of a sell the news type of event? I mean, we see that happen in equities all the time.
For sure. I think it's going to be that big move. You see it with Fed minutes, you see it with Fed reports, what they're doing. You'll see that sharp move up and then kind of a sell-off after. There's been a lot of talk and chatter about this upswing has been some of the ETF providers started to accumulate, to have it be ready. We'll see who comes out if everything gets approved, who's going to be the leader, what's going to take the most market share, how it's all going to work. It would not be surprising, though, like you said, with stocks to see that kind of sell the news event. There's been so much bull case built up into this. Are we kind of front running again, just like stocks right now? Are we kind of front running growth? Are we front running the Fed? Are we kind of front running the SEC approvals? We'll see how it goes. It's kind of like I think what happened when future trading was approved. There was a lot of bullish momentum leading up to it, and then futures trading started, and we actually saw the inverse and started seeing more pressure. Shorting was available, so it would not be surprising, as you said, to see a bit of a pullback after if the ETFs get approved on the sell the news event.
Phil, let's talk about your macro outlook for 2024. Would it be safe to say that the distortions that we saw during the COVID period are largely out of the market and we're returning to more normal?
Yeah, I think that's going to be the big news going into 2024 is a lot of the data points we're going to be looking at are more normal. So you look at the PMI indexes, like the rate of growth in the services sector is positive in America, but it's only just. It's not like that huge spur of activity when we got vaccinated. Manufacturing is negative and it's sort of getting closer back to flat rather than the huge spur that we had with all the stimmy checks. So unemployment, we had 2 jobs for every 1 person looking. Now that's coming all the way back down to more normal levels, and the new jobs and the quits is actually below trend. So I think we're going to have to look a little bit more with a fine-tooth comb at the end of this year for what's really happening in the economy. It's not going to be as easy to work it out. As Chris said, the consumer, even the consumer savings look like they've been worked down. Some of the credit card and car loans are starting to become delinquent. There's a lot of evidence that the consumer is starting to budget a little bit more and spend a little bit less. So it's going to be a more normal economy.
Yeah, Chris, anecdotally, we heard that a lot this year. Like, certainly experiences are still on the table, but even in terms of Christmas shopping, I've heard it a number of times. I'm dialing back. Things are just so expensive.
Yeah, but if you look at the MasterCard spending pulse, it was up 3.1% for this year, which doesn't sound like a big move, but it's still an uptick. Since COVID, you had over a 12% move, 12% increase the first year after COVID, and so over 8% last year. So you're still seeing that uptick in spend, but you also have the rising wages to go along with it. And we talked about this before, and Phil just mentioned it. And you talk about the credit card spend, but when you look at it, as Phil often says, percentage of the wages, it's really not that crazy. So there is tail there on that as well. So I don't know if the consumer is going to be as robust. Nobody really does, but the consumer is still going to be there, and it's going to be, it may not be the forefront of what's going to move it, but it's definitely going to be there supporting everybody on the bottom.
It's interesting you say everything seems so expensive, but that's inflation, right? It goes up, it doesn't go down.
Right.
But wages have actually gone up faster, so people have actually got more spending power now than a couple of years ago. It just doesn't feel like it because all we think of is the prices we're paying for stuff. But the wage growth has really helped the consumer after they've run out of stimulus checks to keep spending despite the inflation.
So where do you think if you look at the inflation and where we're going right now, the one thing that's been really sticky has been housing, right? And that's starting to, it's 7% in mortgage rates now. Only 6 weeks ago it was just about 8%. When is that going to start to help out? And that's another question.
Well, what's the sweet spot? What does 5-6% feel
where
better?
Where are we now? And I don't think we know where we're going to be, right? More normalized, is it going to be 3 to 4% inflation? Is it going to be a 4% Fed fund future rate? What's the right numbers of where we need to be? And most of the people of the last 4 or 5 years have kind of lost gauge that. You got to go back to 2018, 2019 for that normalization. And I don't even know if that normalization is really where we are anymore as an economy.
I mean, housing's one of the few things there's still a bit of COVID stress because actually what everybody did was lock in those low mortgage rates. The average mortgage rate's close to 3.6%. So the fact that the new mortgages are 8%, like if you own your house right now, you're probably not going to sell because you're going to have to refinance a new mortgage. It's going to be more than twice as expensive, and the house prices have gone up at the same time. Houses right now are less affordable than at any time since the 80s, which is when Volcker had interest rates at 14%. So what we really need is to your point, for mortgages to come down enough that difference between my 3.6 locked and the desire to move to a bigger house isn't going to be
right. It's not so painful.
And you'll see people start to move. But right now, there's not much supply of houses, and that's kind of why the prices are still high.
But we see that in multiple asset classes. We got so used for the past 10 to 15 years for the market only going one way. In a very low interest rate environment with the system flush with liquidity, people are just predisposed to thinking we're going to get back to those levels, and it's not going to happen. I mean, these, even where we are right now, are historically normal levels. It's just when you start, if you have 10, 15 years of so much liquidity in the system, obviously COVID, it was an anomaly when it came to housing, right? But I think there's we have to get through almost a generation of thinking that things are that easy.
We're probably going to have positive real rates When the Fed eventually gets down to things, if we've got 2% inflation, even if we get to 3% rates, that's a positive real interest rate. We haven't had that for years.
Right.
And so the question is 1% the right positive interest rate to keep the economy and keep us saving, or is 2% a better number? And actually with demographics as a headwind, it looks like 1% or even a bit less is the right kind of interest rate to not slow the economy down.
And what type of tailwind would that be for equities?
I mean, that's a much bigger cut than is being priced in on the futures right now, and way bigger than what the Fed's talking about. So it's definitely going to be a tailwind. I think the question is the market already bought
There
that?
already. I think we already bought it, right, in December.
Yeah.
It's going to be tough to see where we end up. And then, like I said earlier, the elections, who knows what's going to happen. But this time next year, that'll all be sorted out, hopefully.
And that's why we have all of you guys here at the table to help our viewers digest all of it. Gentlemen, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.